So let's unpack a frustration that trips up pretty much every investor at some point, no matter how long you've been doing this.
Oh, yeah. I know exactly the one you're talking about.
You find a company, and on paper, the numbers just look great. Net profit is climbing, the PE ratio looks cheap, and screaming value.
And yet, the stock price is just flat, utterly flat.
Worse, the company keeps saying year after year that they can't pay a dividend or buy back shares because they're, quote, reinvesting.
It's the classic question, isn't it? If the company is so profitable, why is there never any cash? Why is the stock dead money?
Exactly. And the source material we've been digging into for this deep dive really pinpoints the vanishing act, that reported profit. It's disappearing into something called capital expenditure, or CapEx.
Right. The company is definitely spending the money. The trick is figuring out what they're spending it on. Are they spending it to make you more money in the future, or are they just spending it to survive?
And that is our mission for today's deep dive. We want to give you the analytical tool to answer that exact question. We have to stop looking at total CapEx as just one single number on a spreadsheet.
You have to dissect it. You have to learn how to tell the difference between the money spent just for maintenance, the cost of survival, and the money spent for actual real growth. Once you can do that, you can spot the true cash machines.
And separate them from the ones whose profits are, well, kind of a mirage. It's a critical insight that just fundamentally changes how you value a business.
It really does.
Now, before we jump into the mechanics, a quick reminder. This analysis is all based on publicly available sources. It's purely for educational purposes, not investment advice. Always do your own homework.
And if you're interested in keeping an eye on the bigger picture, the overall market temperature, you can search for and download our iOS app Buffett Indicator right from the Apple App Store. It's a great tool for tracking the key metrics that value investors watch.
Okay, let's start simple. Before we even open a financial statement, let's use an analogy to really ground this concept. Let's just forget spreadsheets for a second and think about a really simple business, like a small taxi company.
Perfect starting point. Simple business model. The car makes the money.
Right. The taxi itself, that's your main revenue-generating asset. But here's the thing. That asset starts degrading the second you drive it off the lot. Every single mile adds wear and tear. So if you, as the owner, want that car to be working just as well next year to bring in the same amount of money, you have to spend cash. You need new tires, oil changes, eventually, maybe a new transmission.
And that right there is the heart of maintenance CapEx. It is money you absolutely must spend. It's mandatory just to keep the business running at its current level.
If you skip it, what happens?
The asset falls apart and your ability to make money shrinks. It is a necessary cost of doing business. It feels like a cost, even though accounting rules let you capitalize it instead of expensing it all at once.
And that's the little accounting trick, isn't it? That capitalization is why the reported net profit can look so good. The full cost of keeping the business alive hasn't hit the profit and loss statement immediately.
Precisely. So the profits look higher than the, let's say, the true economic reality.
Okay, so now contrast that mandatory spending with spending by choice. Your taxi business is doing great, and you decide to take your profits and buy a second taxi, a brand new one.
Now, that's a deliberate choice to expand. You're spending money with the specific goal of making more money next year. That is growth CapEx. That's a real discretionary investment.
So we've got these two completely different things, maintenance CapEx and growth CapEx.
Different animals.
And they're both just lumped together under one line item on the financial statements, total CapEx. One is a cost to survive. The other is an investment to grow.
And the big challenge for you as an analyst is that companies only report the total. They don't break it down for you. They don't say, this much was for oil changes, this much was for the second taxi.
Which brings us right to the hard part. First, where do we find that total number? And second, how do we even begin to split it apart?
Okay, so finding the total is the easy part. You go to the cash flow statement, look for the section called cash flows from investing activities.
Right.
You're looking for a line. It's almost always a negative number because it's cash going out. And it'll say something like cash paid for the acquisition of fixed assets or tangible assets. That number, that's your total CapEx for the period.
So once we have that total, we need a way to estimate the maintenance part. And for a long, long time, the standard shortcut, the one analysts have always used, was to look at a different number, depreciation and amortization, or D&A.
And this is a really crucial distinction. We are using an accounting expense, D&A, which you find on the income statement, as a kind of proxy for a cash expense, maintenance CapEx.
Okay, what's the logic there?
The logic is simple. It's almost seductively simple. Depreciation is the non-cash charge that represents the asset losing value from wear and tear each year. So the theory goes, if you spend an amount of cash, equal to that depreciation.
You've basically canceled out the wear and tear. You've kept your assets in their original condition.
That's the idea.
Yeah.
So the simple formula that comes from this is growth CapEx equals your total CapEx from the cash flow statement minus depreciation and amortization from the income statement.
Can you walk us through a quick example?
Sure. Let's say a factory reports total CapEx of, say, $100 million, and their D&A for the year is $80 million. The simple logic would suggest that $80 million of that was just to fix the old machines. That's your estimated maintenance CapEx.
Which means only $20 million was left over for real growth, for buying new machines.
Exactly. And if that $20 million is tiny compared to the company's net profit, that's a huge red flag right there.
Okay. That shortcut seems really useful, at least as a first-pass screening tool. It lets you see if a company's even trying to grow. But I feel a but coming.
A very big but. As soon as we introduce the real world, specifically a little thing called inflation, that simple equation just starts to fall apart. It becomes a major liability.
This is where the deep dive really gets interesting, isn't it?
It is, because that simple D&A shortcut is built on a massive hidden flaw.
And the flaw is that it assumes the cost to replace an old machine is the same as its original cost, which is what depreciation is based on.
Exactly. D&A is calculated based on the historical cost, what the company paid for that machine 10, maybe 20 years ago. The real world doesn't work like that.
Let's go back to the taxi.
Perfect. So you bought that taxi 10 years ago for, let's say, $20,000. You're depreciating it at $2,000 a year. That $2,000 is your D&A.
Okay.
But if you go to a dealership today to replace that 10-year-old taxi with an identical new one, well, due to inflation, that same car might cost you $30,000 now.
So the $2,000 D&A figure on your books dramatically understates the real cash you actually have to spend.
Year after year. Just to stay in the same place. Your real required maintenance CapEx is way higher than what D&A is telling you.
And for any asset-heavy industry, we're talking railways, airlines, utilities, heavy manufacturing, this inflation trap is everything. It's why their reported earnings can look fantastic, but the actual cash flow available to the owners is basically zero.
Because they're on a treadmill. They're constantly just pouring money into maintenance to fight the rising costs of replacing their old equipment.
It's a battle they can't win just by spending their depreciation allowance.
Okay, let's really connect this to the real world then. If you see a big railway company, one with massive physical assets that last for decades, and they're only spending an amount on CapEx that's equal to their D&A, what's really happening?
They are not maintaining their status. They are, in real economic terms, shrinking. It's a form of financial delayed maintenance. They are letting their assets slowly degrade because they aren't spending enough cash to replace them at today's prices.
So they're either taking on debt to make up the difference, or they're just kicking a giant repair bill down the road for the next management team to deal with.
The implication here is huge. It means those companies' reported net profits are basically a work of fiction.
They're inflated. Inflated by the fact they are underreporting the true, real-world cash cost of simply staying in business. The true economic profit, the cash that's actually available to you as an investor, is much, much lower than what the income statement shows.
Which forces us to move beyond that simple formula. If D&A is flawed, especially when there's inflation, what's a better tool? How can we estimate the true maintenance CapEx?
Right, because we can't just call up management and force them to use what's called replacement cost accounting, even though that would be the most honest way.
So we have to find some kind of external benchmark.
Exactly. One of the better methods is to look at historical industry data. You find similar successful companies in the same sector, the ones that have clearly maintained and even grown their assets over decades, and you calculate their capital intensity.
How do you do that?
You measure their historical total CapEx as a percentage of their total revenue, and you do it over a long period, like 10 years, to smooth things out.
I see. So that's a great approach because you're not relying on the company's internal historical accounting. You're creating an external, real-world metric based on what it actually costs to compete in that industry.
Precisely. So if you find that historically successful railway companies have to spend, say, 12% of their revenue on CapEx just to stay competitive, and the company you're looking at is only spending 8%.
That 4% difference is likely chronic underinvestment. It's delayed maintenance CapEx.
It shifts the question from what did the accountant write down to what does it actually cost in cash today to run this type of business? You're setting a realistic floor for maintenance CapEx based on industry reality.
So, okay, let's tie this all together. What does this all mean for you, the person listening, when you're trying to make better financial decisions?
It means you have to shift your focus completely. The most important question is not how much net profit did they report. The question is, what is the economic purpose of their capital deployment? You have to break down that CapEx number. If a company is sinking almost all of its cash flow into just keeping up with inflated maintenance costs, it's not an investment, it's a treadmill. And that stock is dead money until something changes.
And this leads us directly to the only number that really matters to an owner, which is true free cash flow. We have to define that correctly.
Right. True free cash flow is the cash that's really, truly available for things like dividends, paying down debt, or actual expansion. And to calculate it, you must subtract the real maintenance CapEx, the money that is not discretionary, from the company's operating cash flow.
And if you just use the reported D&A number as your maintenance figure in an inflationary asset-heavy business,
You are almost guaranteed to wildly overstate that company's true free cash flow. This kind of deeper analysis pulls you out of the trap of just looking at the reported numbers and forces you to think about the reality of the business.
it forces you to think critically, to question that core assumption that an old accounting number is a good enough proxy for a real-world inflated cash expense. You now have a key tool to look past an attractive net profit number and to really assess if those earnings are just masking huge necessary maintenance costs that are slowly eating away at the long-term health of the business. You have to decompose CapEx.
And that leads us to a final provocative thought for you to chew on. If you see a company in one of these inflationary asset-heavy sectors, like our taxi company, trying to replace its old fleet, and their total CapEx year after year just happens to exactly equal their D&A,
What does that imply?
what does that really tell you about the quality of their assets and their competitive position 5 years from now? They are, in effect, slowly liquidating their own future.
That is some food for thought. That maintenance cost isn't just a number. It's the gatekeeper to a company's entire long-term future.
Absolutely. Now, if you found this deep dive useful and you want to explore even more advanced content like this, we'd welcome you to join the Deep Value Club membership. And please don't forget to subscribe to the Deep Value Investing channel on Apple or Spotify podcasts.
And remember our disclaimer. All of this content is for educational purposes only. It is not investment advice. Please conduct your own due diligence before making any decisions. And you can track the total market temperature by searching for and downloading the iOS app Buffett Indicator from the Apple App Store. Thanks for diving deep with us today. We'll see you next time.